Finally, on this Saturday, 9 p.m. Indian time, we are running a webinar for Introduction to Python. Completely beginner friendly conversation, free of cost. It's live. It will be free only live. After that, it will be uploaded in the member community. So please join that. We will post details about it pretty soon. Hello everyone. Welcome to QuantLab. QuantLab में आपका स्वागत है. I do a lot of videos about AI where I talk about how AI can help you improve your trading journey, how you can leverage technology to do better analysis, to build algorithms to do backtest. However, what constantly keeps on happening is a lot of people approach me with a simple problem that can we use AI to predict stock prices? I have done a couple of videos in this space. If you have not watched them before, I'll just put them somewhere above in the link. Do watch them. However, what I wanted to do in this video is just take a little bit more deep dive and talk about why using AI for stock prices are a bad idea. I am not essentially saying that do not use AI in your whole trading journey. I'm just trying to be very specific and trying to say that you should not be using AI to predict stocks. You can definitely use this to predict a lot of different parameters, but pure prediction of numbers is a poor idea by far and large. And why that is the case, I will talk about it. The first point is stock markets are inherently unpredictable. Now, what does this mean? If you look at the simple image that I have picked from the internet, there are about, 1, 2, 3, maybe 12 factors that I've listed. And I'm sure there are more. What does influence stock prices? News, incidents, wars, GDPs, market demand, unemployment, economics, finances, monies, black swan events. Too many things impact markets. You can think of the markets as driven by sentiments by far and large, and that is the most common approach in which investors have learned to treat markets. What drives these sentiments are any of these factors, right? Sometimes these factors are factored in the price, or sometimes they are not. If they are factored in, you would not see that degree of choppiness. They are not, if it's a surprise, you will see a knee-jerk reaction in market. So market react really on sentiments by far and large. Yes, there are technicals at play. Yes, there are fundamentals at play. Yes, there is a notion that longer term markets always make money, indexes can help you make money and things like that. But again, purely speaking from a prediction perspective, too many parameters. Second, past performance is no guarantee of future returns. I think म्यूचुअल फंड में भी डिस्क्लेमर लिखा रहता है हर जगह कि मार्केट इन्वेस्टमेंट्स जोखिम के निवेश है एक्सेट्रा एक्सेट्रा, मतलब कि जो पहले हो चुका है उसको यूज करके अपने डिसीजन मत लो, सिंपल एज दैट. The same applies for AI models as well, because while you might build a model with a traditional understanding of the system, you might be still able to cook up a lot of data, find sources of data. The challenges is that past performance cannot be used as a measure of future return. This is a very easier statement to say but very hard to implement, because most of the times we build strategies on past data and we use that to analyze it and then try and build some nuance of the future. However, purely in machine learning parlance, this is a really deep context. So if you're building models, please understand this. Overfitting, underfitting, you have some sort of high training error, high testing error, underfitting. You have some sort of an optimal scenario and you have an overfitting scenario. The problem is that getting a very generic AI model that is optimum for so many large different of parameters where there are numbers, liquidity, technicals, news, sentiments, etc., very difficult. You might be able to get a directional indication. Like for example, you can definitely predict a trend. You can try, predicting some sort of stop losses, and then we can argue that stop losses are also in a way trailing prices, right? That's true, but stop losses have some properties which make it slightly more associated with it, and there's a margin of error that you're actually dealing with, right? It's essentially not the actual price. It's a little, you're already factored in that there are few percentages drop. So stop losses are a good thing to predict if you want to really get into prediction. So getting an optimal model becomes very complex. Why does it become complex? Is because बहुत सारा data है, बहुत मुश्किल है ये कर पाना. All right. So before I go in the next problem, a small plug about the channel. There are a lot of free perks available in the channel, free WhatsApp groups, lot of discussions happening. please click in the description. You can find discount codes for a lot of brokers, tools, technology providers, etc. etc. Please click and use them. Second, I do provide all of code which I run in my channel. So if you want access to that, just join the membership. It's literally like 200 rupees. Itna to ek stop loss mein bhi chala jata hoga. Talking about stop losses. And finally, on this Saturday, 9 p.m. Indian time, we are running a webinar for Introduction to Python. Completely beginner friendly conversation, free of cost. It's live. It will be free only live. After that, it will be uploaded in the member community. So please join that. We will post details about it pretty soon. Let's come back to the channel, to the discussion. The fourth point is that most models are black box models. Now, when you have some sort of a result coming out of a model, you want to understand what is causing it. What is the reason that the model is figuring this out? Why is it giving this prediction? And unfortunately, the black box nature of a lot of models make it very difficult in understanding the system as such. So essentially AI हो जाएगा but उसको explain नहीं कर पाएंगे. So when something is not able, we are not able to explain, it becomes very difficult. So yeah, that's the impact. Couple of additional pointers before I close this, 4, 5, 5, 6, 7 points, like 3 last points. First is high frequency trading and market impact. Now what is happening and what world is going towards is there's a lot of algorithmic trading happening, and this is increasing day by day as markets become more mature, as technology providers become more mature. इसका side effect है that the choppiness in the market is much becoming higher. The rate at which you respond is becoming very, very fast. You need to respond basically. So much of variations, volatility arising from these sort of players in the market can distort the prices. There are traps also laid out which are more understood by seasoned investors, like zones that are created where people might get into panic mode and sell it, and then somebody buys it and it goes up again. There are zones that are created of euphoria as well, like let's just push the market, governments even drive market, all of that. So again, going back to uncertainty, sixth point I think is very, very important. Now these points are not in some order of priority. Like sixth point is data quality and availability, and I was talking about this. बहुत मुश्किल है डेटा मिलना. Like it's very difficult to get data to build an AI model in Indian markets, because you can get the regular trading data, you can get some historical data free of cost, but paid providers are very costly. Reliability is a question. Second, to what level of granularity you want the data. If you want something daily, hourly, minute level, mil jayega. If you want more granular, like tick by tick, very difficult. If you play in options, even further difficult. You already know what I'm talking about. Then comes the whole secondary data sources, right? Economics data, sentiment data. kahan se laoge? There are very limited providers in the country that do this, and most of them are only selling to institutions. So as a retail trader, it becomes very difficult to access all of this data. You can definitely say that, okay, I'll scrape off money control, ye wo falana dimaka, but the side effect of that is, then you get into building a model for sentiment analysis and then using it, finding the impact of that, whether it is dampening impact, whether it is a multiplication impact. It's a very hefty exercise. And also EQ plays a large role, right? AI will not get the EQ. Human beings has that EQ, at least so far. So if the model does not have that emotional understanding, that intelligence that people use as insights in the market, it becomes difficult for the model to understand one dimension of the market at least. Some people might take this as a plus, that it's not having the same issues that human beings do, like in terms of decision making, ki loss book nahi kar paye and all that, and profit right time pe cut nahi kar paye. But again, that is a parameter. If you think from a modeling perspective, EQ is very, very important for markets. And again, to my whole point of this narrative, that markets are driven by sentiments, finding the data that affects those prices and the numerical values for the sentiments are very, very difficult. All right, so yeah, that was a short commentary on why you should not use AI. Obviously, you should use it for a lot of different purposes. Uske liye baaki videos dekh lo. Thank you for watching. Bye bye.